do with the real estate investment trust in this environment? Many of these stocks became punching bags right after the Fed tightened in December because higher interest rates make the juicy dividends of the REITs less attractive. But since then, as it's become clear that the Fed is being slow and deliberate about any additional tightening, the group has bounced back, and it's done so with a vengeance. Take EPR Properties. EPR, it's a diversified REIT that owns entertainment, recreation, and education-related properties like megaplex movie theaters, retail centers, golf complexes, ski parks, water parks, and charter schools. Recently, they've even begun to dip their toe into the casino space. Now, EPR has rallied 16% since the Fed raised interest rates in December, in part because this is an incredibly well-run REIT with a robust pipeline of new projects, not to just mention, well, a bountiful 5.9% yield, even after the stocks moved up a lot. Company just reported last night and delivered yet another excellent quarter, with EPR's funds from operations, the REIT equivalent of earnings, beating the estimates by a penny on higher-than-expected revenues, up 19% year-over-year. At the moment, the stock is just a couple of points off its high, although it didn't do much today. I bet it's got more room to run. So let's check in with Greg Silvers, who's the president and CEO of EPR Properties, hear more about the quarter and where his company's headed. Mr. Silvers, welcome back to Mad Money.
Thanks, Jim. Glad to be here.
Greg, I got to tell you, since we spoke last, we didn't have any clarity before about the casino properties, and I think it's such a kicker. This time I just want to go there because we're getting far along. Tell people what it would mean to EPR Properties.
Well, for us, it's truly been a very successful story here recently. The property that we owned up in upstate New York received a gaming license. Empire Resorts, through its operating company Montrain, has now received the gaming license. They've started construction. So for us, what it means is a $600 million casino facility built upon our land. We're a ground lease parcel. They've raised all of their equity within the last quarter, approximately $300 million. They're under construction right now, and it's very much a positive outcome for us.
And what time frame should we look? I don't want people to get ahead of themselves. I mean, this is obviously a multi-year proposition.
Yeah, it's generally going to be about a 24-month build cycle, but along with that, it's a whole development. We've got a water park hotel, indoor water park hotel going on. There's an entertainment retail area, so it's really a full-service kind of entertainment and leisure resort anchored by the gaming facility.
Hey, Greg, I was trying to figure out, I think when people see acquisitions, we have Adam Aaron on from AMC on our air and talking about the buy of Carmike. When you see a change and some M&A in your world, what does it mean in terms of possibilities for you guys to do have a bit more runway?
Well, for us, it's always positive in the sense that as we see those opportunities, whether it's by divestitures or they want to invest more capital in the conversions to the new high amenity theaters, we're very excited about what that means because it generally means more opportunities for us, which allows us to deploy capital, raise the dividend, as we've done before, and continue the growth pattern that we've been on.
Have any of the Carmike cinemas actually done the kind of cool things that I want you to explain to people that you guys do?
Yeah, they've not really invested in it like AMC. AMC's been a leader in this category. They've really kind of led the way. I think that's one of the opportunities that AMC sees with the Carmike transaction is to deploy additional capital and raise those high amenity theaters. And we're talking about luxury seating, fully reclining, enhanced food and beverage. It really has changed the value equation. It's driven kind of results. Year to date, we're up nearly 8% at the box office. So this kind of revolution that's going on in the theater business is actually allowing us to reinvest along with our operators, generate great returns for our shareholders, and feed a pipeline that we think can stretch into the future.
Good. We're trying to figure out some of the things about why your stock has been so much better than the others, frankly, in the group. And one of the things I've been thinking of is we spend a lot of time thinking about what millennials do. And millennials, we've realized, are not as materialistic as they used to. They don't go to the mall. They don't go buying things. They tend not to even want to buy a lot of clothes. We see that. They want experiential opportunities. They want to go places and experience things. How does that play into EPR Properties' return?
Well, Jim, thank you. It's like you were a part of my earnings call yesterday, because we said that with the growing recognition of the experience economy, especially in millennials, we started our call with saying welcome to the party. Because if you look at our portfolio, be it entertainment, recreation, education, we partner with some of the greatest providers of congregate experiences in North America. These are the type of experiences that millennials desire. They build memories. It's what this new segment of demographic shift is looking for, and we're at the front edge of that, and only see that growing and being more valued by investors as we move forward.
Well, I think that's a great point. You are at the forefront because the REITs that are valued more highly than yours tend to be concentrated with a couple of retailers. To me, that's far higher risk than what you're doing.
Well, we look at it similarly in the sense that the economy of stuff, or we talk about, is really moving to the economy of experience. We've been very successful with it. We're seeing the trends grow. But remember what I said, our operators are not sitting back on their laurels. They continue to reinvest in the properties. They continue to change that and reinvent themselves with some regularity so that experience changes. If you're in the movies, that experience changes every week with content. So this is something that we're not simply dependent upon a retail category that comes in and out of favor, but we've got constant content renewal, and it's something we think makes our property and our portfolio very unique and valuable.
Well, one last question. I know there's always been some concern. Well, hold on. How about a bad winter? Because you've got some things that are affected by that. We had the warmest winter in ages. It didn't really impact. You didn't skip a beat, right?
No, we didn't. In fact, we talked about it on our call yesterday. All of our ski operators have fully funded their reserves, meaning that we already have our rent until next December into an escrow account. So we're fully funded. We've talked about the fact that we plan for this seasonal. We understand how to underwrite it, and we've been very successful doing it, so it's not going to impact us economically.
All right. Well, congratulations on still one more good quarter. And the fact is that you just keep making money for our viewers. Really appreciate it. Greg Silvers, President and CEO of EPR Properties. Great to talk to you, sir.
Thank you, Jim.
All right, guys. What they do, you have excitement at. What I want is a company that generates a good return and goes higher. That is unexciting. And I think EPR fits both bills. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.